John Glen, thanks for your time today. Let's start off with the big question surrounding the rise that we've seen today, announced a couple of years down the road in corporation tax. Can Brexit Britain really be economically competitive if the Chancellor is raising corporation tax in such a significant way?
Well, it's raising corporation tax for the largest businesses to a rate that is still making us the most competitive in the G7. So I think it is got to be seen in that context. And he's looked very carefully at the range of suggestions. And he's also protected smaller businesses to maintain the existing 19% rate and then put a taper in those between 50,000 and £250,000 of profits. So that intervention in 2 years' time, when the Office for Budget Responsibility says that the recovery will be underway, is designed to deal with the compelling logic of addressing the challenge to our public finances, where if we have a 1% increase in the interest rates, we'll see a £25 billion increase in the amount of debt interest that we're paying. It's for that reason he's made that tough choice.
I appreciate that it is a tough choice. This comparison in terms of the absolute rate on a kind of global geographic comparison, is that really the way that we should be looking at it? British business is going to be shouldering a huge portion of the recovery in public finances that we're going to see over the next few years. By 2025-26, the share of GDP in terms of tax receipts coming from this sector will be the highest since 1989-1990, and that is comparable or even higher with other G7 countries around the world.
Well, if you think about financial services, if you think about what the Chancellor announced today in terms of the bank levy surcharge and the reform of that, then that is very significant too. But what he also did today was actually be really innovative in terms of the super deduction, the ability over the next 2 years to actually to take capital investment and make it a relief for 130% of it against tax bills. That's designed to encourage investment in businesses. But of course, we've got to do whatever it takes to be competitive. And he also announced the Jonathan Hill's listings review for the City of London, so relevant to the city today, alongside Ron Khalifa's independent review of fintechs announced last Friday. Those two give us a compelling set of interventions which will continue to, I believe, make London an attractive ecosystem for financial and professional services.
Another part of that was also a new visa that Sunak announced to attract some tech talent. So seriously trying to compete on the tech front and the SPAC front, the listing front with New York as well as San Francisco. How much money do you expect to come in? What kind of talent, what kind of generation in terms of tech, what kind of SPAC listings are you expecting that you think you can get?
Well, the listings review that Jonathan Hill did recognises the fact that we, in order to be competitive with global jurisdictions, and I count Singapore and New York in those, we've got to attract more tech listings. So we've got a number of proposals there in terms of the float rate, in terms of dual listing. But you're right to focus in on the visas, the non-sponsored point-based visas, which will have a direct impact in terms of tech talent. We've got specific types of skills that are needed in fintech, including AI and other skills that will come from other jurisdictions. So we need to move swiftly to address that, and that reflects one of the recommendations from the Ron Khalifa review. In terms of the quantum of investment, we will do whatever it takes to maximise the opportunities for investment in London, attend to high standards globally, but move nimbly to recognise the challenges and opportunities that we see ahead of us.
John Glen, do you think there's anything really innovative in any of this, though? What I see in terms of this report, what I see in terms of the visa story that you've just been outlining, is what other countries are already doing. What I don't see is anything new and particularly innovative from the UK, which is going to make it stand head and shoulders above everybody else and make it globally competitive.
Well, I think the super deduction in terms of helping encourage investment over the next 2 years will move us from 30th place in the OECD to first. I think that is radical and innovative and is transformative compared to where we are now. But of course, across different sectors of the economy, we will need to continue to make different interventions. We've announced a significant advance in our levelling up agenda across the United Kingdom, an investment in a new national infrastructure bank. And we're continuing to recognise the opportunities for investment outside of London and the South East as we try and address the opportunities across the economy as a whole.
So, John, just to add on to that, what's the goal? Like, how much talent do you think you can really attract? Like, what are the numbers here? What kind of money do you think you can attract?
Well, we don't quantify specific goals. What we do know is that we are in a globally competitive, fast-moving environment. And as we've left the European Union, it gives us opportunities to keep to those high standards, but do things slightly differently. And I think the FinTech review and the listings review are two examples of things that we've moved very quickly to address some of the opportunities that the City of London say that exist for us.
One thing that does stand out here is that corporation tax is going to become more complicated. Over the last few years, chancellors have tried to make the tax code more understandable and more transparent. There's a lot of kind of things being added in here that are going to make the tax code more complicated. John, do you think that's going to be something that British business is going to have a problem with? Simplicity works when it comes to tax codes. You seem to be making it more complicated.
It's quite straightforward to me. Profits up to 50,000, you pay 19%. Between 50 and 250,000, it goes up gradually. And then from 2023, when you make profits over £250,000, it's 25%. And that is still lower than our friends in the G7. That's quite straightforward. And I think it gives clarity to businesses as they plan the years ahead. And I think that's what the Chancellor wanted to achieve today, set a roadmap for the economy, be honest with the British people about the public finance challenges, but also support them through this transition back to normality at the end of the roadmap at the end of June.
Do you think you're going to be under pressure to keep the super deductions in place? British business is going to find itself in a world where for the next 2 years, you are very much going to encourage investment. And I think British business broadly will welcome that. I think everybody will be on board. Nevertheless, in 2 years' time, British business is going to be hit with a significant increase in corporation tax. Are we going to end up with a situation where we're going from feast to famine over a relatively short period of time? Do you think, as a result, the pressure will be there to keep this investment incentive in place?
When the Treasury do data-led policy based on consultation with businesses, and we will continue to have deep dialogue. I've spoken to over 30 CEOs of city institutions over the last 8 weeks, and I'll continue to engage very closely with the representative organisations that are in my sector, and as will my colleagues across government. And we stand ready to do whatever it takes to support the economy through this difficult period, coming out of a challenge that has been unprecedented in 300 years.